So Troy, my inbox is always full of different types of opportunities, financial opportunities, investing opportunities. And I've heard that options is pretty risky. And I don't quite understand why it is you chose to build an entire platform around options trading. Can you help me understand why you did that?
You know, all big fears or misunderstandings, they all have some truth in them, right? There's always both sides of the story. And you know, people being afraid of options and hearing that options are really risky is very common. It's probably the single most common thing that people say to us when they are learning this framework is, hey Troy, aren't options risky, right? Well, you've been fed that by the industry for years. And there's lots of reasons for that. And part of it is because it's true. They can be very, very risky, right? But think of it like driving a car. Now, if you drive 150 miles an hour everywhere you go in a Lamborghini, then that's pretty risky, right? But if you are staying to the speed limits and you're not distracted and you're paying attention and you're just, driving like your grandmother, well, maybe a little better than grandma, then, it's not a risky endeavor. People drive every day and don't have any trouble. Well, options kind of has that duality to it. There are options that are extremely risky, and that is something that we don't do in low stress trading. We want to keep things in that low stress zone. And so we only use very, very conservative option strategies. In fact, while there are dozens and dozens of option strategies that I could teach, there's only 2 that we teach inside of this training. We only teach you the 2 most conservative option strategies that are around, and that is selling puts and selling covered calls. And those are cash secured puts. That's very important to understand. Don't worry if you've never heard of them, but it's important to have that distinction because we don't use margin. And this is another fear factor that people have regarding options trading because they think, oh, I've got to use margin. And I've got a friend that got a margin call and blew out their entire account, lost their entire retirement. And that can happen. And it does happen in margin risky strategies. In fact, just Christmas Eve, there was an infamous trader, I won't use names because I don't want to disparage anybody, but he was trading a very risky strategy with options. He had over 1,000 students follow him and copy trading him in on the strategy that he was doing, and they kept doubling down and doubling down and doubling down as the market was going against him. And he blew out over $50 million on his account right before Christmas. So yes, options can be risky if you don't do them the way we teach. And so understand that while that is true, the converse is also true. And 2 things can be correct, and they are in this case. So let me give you an example. Options are also safer than buying stock. Now, this is something that really blows the minds off a lot of people. They can't make that connection. How can options that I've heard are so risky be safer than buying the stock? Well, because with options, if you do it the way that we teach, selling puts and selling covered calls, you're generating income every single week. And that's one of the, I don't want to reveal the strategy too much here, but it is one of the secret sauce ingredients is that we only trade weekly options. And we do that so that we can compound our results every single week. We're making a little bit of money week after week after week. Now, think about it like this. Let's say that you bought Apple stock, and like many people, Apple is kind of expensive, and so you couldn't afford to buy 100 shares, so maybe you only bought 6 or 8 or 10 shares of Apple stock. Well, now let's say, fast forward to the future, and Apple crashes, and it pulls back maybe 20% or 30%. Heck, maybe we have a big market crash and it pulls back 50%. Well, you've only got 10 shares of Apple stock. What are you going to do? There's nothing really you can do. And this is why I call the traditional investment strategy buy and hope. I don't call it buy and hold, although you are holding on for dear life in that situation, but I call it buy and hope because you're buying the stock as an investor, and you're hoping that the stock is going to appreciate. You're hoping that that stock is going to go up. You're hoping that when you retire, the stock will be at a new all-time high. And there's a lot of optimism there. there's a lot of hope. And, while I love optimism and I love optimistic guys, I'm more of a pragmatic pessimist. And I mean that to be sincere. Like I see myself as pragmatic in the middle. I don't, hope for the worst, but I want to be prepared for it. And so when you're trading options, what's different is instead of buying Apple and buying 10 shares, well, you're trading a contract of Apple. And that is a leveraged option contract. And don't worry, we'll explain all of this inside of the program. So if you don't know it, that's totally fine. But what it does is it gives us the ability, because we have a full contract and 100 shares of that stock that we're trading, we're able to sell options on that contract, and we're able to generate weekly income off of that position. So we're not an investor, we're a trader. Investors are going to make a trade and they're going to sit on it for weeks, months, maybe even years before they do anything. And they're going to what? Hope that it appreciates, right? I'm not putting any stock in, or my family's retirement or the wealth I want to leave for my children in hope. I instead am a trader. And so what I will do is sell those weekly options every single week. And when we do that, we make a little bit of profit every week, and we start to chip away at our cost of that stock. So if we bought the stock and it goes down 30%, well, every week we're making a little bit of income, a little bit of income, a little bit more. And what that does is it lowers the cost of entry into that stock position. It's as if we could take all that premium that we've generated, all that income, and deduct it off the stock price that we paid. Right? That's what we essentially do when we're trading options. And so we can afford to be patient and disciplined and just continue to sell those weekly puts or those weekly covered calls and continue to chip away at that stock price, so that even if the stock is going down, so is our average acquisition cost of that stock. And this is what makes selling puts and covered calls inherently safer than even owning the stock itself, right? Because we don't have to be concerned with that. We have the ability to be patient, disciplined, and continue to print weekly income that reduces our stock entry price over time. So are options more risky? Yes, if you do them wrong. Okay? If you're doing crazy stuff, they can get really risky. But if you follow the structure that we lay out, the framework that we teach, and you only sell options. We never buy, we only sell. Okay, the difference is, if you think of the gold rush, you had the store owners, and the store owners would sell picks and axes and shovels and flour and bread, right? They sold supplies, and they made great profit off of that. Now the speculators, what did they do? The speculators would be on the buying side. They would buy all of the supplies, and they would also go out there and speculate that they were going to strike it rich in gold on their trades, right? Think of it as a trade. That's what they were doing. So you have the sellers and you have the speculators. The sellers are the ones that got rich in the gold rush, right? The speculators, what happened to them? Most of them never struck gold. And most of them went into debt with the store owners, borrowing money for supplies, and at some point would literally sign over their mine, the deed to their mine, to the store owners, because they couldn't hit rich. They couldn't hit the nuggets. They couldn't find the gold, right? And they couldn't make those trades. And so what ended up happening, the speculators, high risk, high failure rate. But the store owners on the selling side, they kept it simple, and they kept bringing in profits week after week. That's what we do in this particular strategy. Look, if you're looking for, all the excitement of day trading and, the high and the rush, you're not going to enjoy this strategy. I'm just going to tell you that straight up, because we're not that way. This is a mindset where we stay patient, we're disciplined, we follow the framework, and you know what? We're just boringly profitable. And I don't know about you, but I want to save my excitement for the zip line or something fun with the family. I want my trading and my income generation to be just boringly profitable.
Hey, Troy here. If this resonates with you and you want to dive deeper into how all of this works, I've created a free masterclass series just for people like you. So low stress you can do it in 1 to 2 hours a week. So low risk the government allows you to trade it in custodial retirement accounts for children. And so effective it targets up to 68% returns per year. Click the link below to sign up and let's continue this conversation in the training.